Tomorrow we've got the FOMC, and then right behind, of course, is none other than Fed Chair Jay Powell, who's had a little bit of a rocky relationship with markets lately. Joining us, William Lee, the chief economist at the Milken Institute. Bill, good to have you back.
Oliver, thanks for having me.
Okay, so what are we looking for this week? Anything new in the language? What's the top of the list in terms of what you're looking for that the FOMC might tell us?
I and the markets are going to be trying to find out how set is the Federal Reserve Open Market Committee on the view that inflation will be temporary. And we already got a hint that there's some dissension within the Fed, because Kaplan, in his earlier talks, after the meeting, has said he would be one of the first to raise rates if the growth continues at this very rapid pace and pushes inflation beyond the 2.5% number that they all have in their heads for a longer period of time than anticipated. But I think the main message that we're going to get out of the minutes is that the consensus is solidly there. The Fed story is the inflation is going to be transitory. Productivity gains and goods price deflation from globalization and trade is going to continue to act on prices in 2023 and 2024. So whatever bottleneck price increases we get will dissipate. And I think that's the main message that we're going to see in the minutes, but also Powell is going to have to reinforce in his future talks, because markets just don't believe it.
Bill, I want to get to that part in a sec, but just firstly, for the kind of inside baseball drama within the different Fed views, does anyone but Jay matter? I mean, if a few people dissent, isn't it like good measure for optics? Does it cause any volatility, or is it going to be what Powell says?
Well, Oliver, you're more cynical than I am. That's amazing. I agree that I sometimes think that some of the debate within the FOMC is staged just to show that there is just not a rubber stamp. Go ahead.
No, I was just saying that's kind of what I think too. I have no reason to think that. It just sometimes feels like it.
But I think you also have been hanging around economists long enough to know that once you get a bunch of economists together, no one's going to agree perfectly on one baseline forecast. And I think that's what you're seeing are differences in professional judgment. And Dallas has always been sort of the maverick Federal Reserve Bank out there. It's had this crazy index for exchange rates, and Kaplan has been a voice of sanity in the Dallas district. And I think Kaplan is someone to listen to, because he's really a really smart guy. If he says that I worry about the upside risks of inflation, it's because he's trying to remind everybody that when we try to pursue guns and butter, that is, we have a massive fiscal policy that is geared toward infrastructure, reviving the economy, and doing all these good things. That was when we had a bout of inflation that took off in the 60s and 70s that took a decade to get rid of. So I think that's the downside risk that Kaplan wants to remind us of. Loretta Mester was just on the air yesterday and trying to tell everybody that, there are calmer heads out there, and we understand history, and we know inflation will be caused by bottleneck supply chain effects, and it may last 6 months or even a year, but that's about it. And once the supply chains come back online, we're going to see the deflationary forces take over again. And I think the markets are forgetting that the forces that have propelled the U.S. economy to this massively high growth rates that we have now have been productivity gains that have come from the reorganization of businesses and the application of technology and software. Well, guess what? The COVID incident that we've had in this last year has just accelerated that even more. We're going to see more productivity gains, especially in the service sector, and we're going to see a drop in goods price inflation, because we're going to reorganize our global supply chains to make them much more regional.
So the short term is the way you're viewing the inflationary impulse as well, something that actually, in our efforts to repair the economy, we can reduce our susceptibility to inflation overall. I think it's a super interesting point, Bill. And one of the things you've talked before and you've discussed with me as it relates to the stock market is that some of these big tech companies will be poised the most to reap the benefits from that. So I want to kind of get your thoughts on that, as we have over the past week seen this kind of a dash back into the high quality balance sheet tech names.
Oh, absolutely, and I think about time. This fantasy narrative that everyone has gone on that, oh my God, if you raise interest rates, they're going to raise the denominator, the discount rate. That discounted cash flow model is going to tell you immediately you got to drop the prices of long duration assets. And who's the long duration asset out there but these high growth companies? That's so idiotic. If those kids, if anybody were in my economics class and gave an exam answer like that, I give them a D, because you got to remember. When you have growth, you have a lot of profits. And unless you somehow think that the profits will not feed into these software companies who are going to be selling more of their goods and services to the service sector, the numerator is going to go up as well. So I think right now we finally see the markets understanding that a little bit and trying to buy back some of these very high quality growth companies, and also to see where the structural shifts are going in the economy. Legislation has been put in place that says no more internal combustion engine cars after 2030, 2035. Well, come on. Why is Tesla not taking off like crazy? Why is it that the electric vehicles from GM are not taking off? I know GM has doubled and Ford has gone up a lot because of this push to electric vehicles, but the leader in the field should be way up there. And what do we see? We see every time Ford and GM announces a competitor, we see Tesla going down. That just means that the markets perceive EVs as a zero-sum game as opposed to an expanding universe that provides profits for everybody.
Bill, I love when the economist veers into the stock market realm. So let's roll with it for a sec, because I think this is a really interesting point. What you're saying is that the fundamental reason for money making, revenue, and bottom line for big tech companies, and Tesla in particular here too, with the policy side on EVs, is that they should be doing basically the opposite of what they've done, which is trail the market over the past month, which is essentially saying, well, the market's been wrong. So what is the market telling us about the perhaps burdensome valuation that these companies have already attained in this equity market that just piled into stocks when the economy was going into the gutter the first 4 months of this thing last year?
Well, one of the things I think that when I was at the IMF and the Fed, I would have said markets are rational. They make use of all the information efficiently. Having spent 6 years at Citi as the chief U.S. economist, I now know that equity analysts are not all there. They're very specialized, and they don't make use of all the information as efficiently as possible. So I think it makes sense that the equity markets will take some time to understand that we've had a structural shift in the global economy, not just the U.S. economy. EVs are the biggest thing in China right now, and that is the second largest economy in the world. And who's leading the pack there? It's Tesla. So to me, I as a novice in this game, to me, Tesla seems to be the obvious choice for the market leader, and will stay there for quite some time. But one of the things that you have to remember is that as markets themselves become more efficient, they start to gain the information. The divergence of views among equity analysts and sector analysts will again be almost as wide as the gap among economists. So I think the divergence of views is something that has caused the equity markets to slide from one narrative to another. The reopening trade, the Disneys and the Boeings of the world, and then the Cathie Woods that say, if you stay with these older companies, you're going to miss out on the huge amount of profitability and productivity gains that come from the application of new technologies. So there's your divergence of market views.
I like that. Bill, with that, I know we're kind of veering here from the Fed, but look, we know what they're going to say. Let's keep going with this. I like this because when we have this big move from an investment standpoint, we're seeing equity holdings as a percent of household wealth back near the highs historically. Everybody knows the trend of the quarantine period of new traders entering the market. Their favorite stocks are the ones that are hurting. Now, you're making the case that many of those shouldn't be under pressure. But on a hypothetical scenario where the market, for whatever reason, has kind of priced out all this stuff that's coming down the pike, if the rally has been an expectation of that and these stocks don't go back to the highs, what does the economist in you tell you about what could the impact be in the economy if we're all banking on people spending their savings, going out, going to the store and buying? If their money's locked up in Tesla and Tesla takes another leg lower, down 30% off the highs, what does that mean for the economy, Bill?
Well, one of the things that you have to remember is that the amount of spending that takes place will depend upon how confident people are in the future. Will they be able to have their jobs? Will they be able to get back into their not only their old jobs, but better paying jobs as the economy opens up? So the chink in the armor of the good forecast and strong revival that I've been painting so far has been a lack of confidence that when the laid off restaurant worker goes back and looks for a job, the restaurant will no longer be there. It's going to be a takeout. It's going to be a delivery service. And now what is he going to do? And that the ability of the economy to move the restaurant worker into a software company or into a job where we can make use of his people skills or her people skills and organizational ability, that's going to be the key to having an economy that fulfills the profitability and productivity gains that I talked about. I have my doubts about that, and as an economist and a natural pessimist, I think that the path to that recovery may actually take much longer, and that getting back to the Fed, the Fed's new mandate now is to maximize the degree to which employment is benefiting the least served members of the economy. And those who are left out, the minorities, the women, and the people who have who have left the labor force, if the economy is able to draw them back in, right, then the Fed will say we've been successful in our mandate. That's what they mean by maximum employment now. It's not just a number like 3.5%, but it's also the distribution of employment. I'm not sure that we're going to get the productivity gains that we hope for if we don't have an adequately trained labor force. And I think that's where it's going to be key to incentivize businesses to train the people they need. If we leave it to government, I'm absolutely convinced that they will train in last year's businesses and last year's industries, and we'll get, again, people who are not as productive as they can be, and we will miss out on these productivity gains, and we will see the inflation that the markets are fearing. We will see an opportunity for bond market vigilantes to come out and say, hey, these inflation expectations are no longer anchored at 2.25% as they are now, but instead they're going to drift up to 3% and 4% because we don't have enough adequately trained workers to expand the supply of goods and services that people are demanding.
I like it. Really interesting to hear both kind of the main core view that you hold and then the potential for it to break down and where that would come from. Academic and enriching as always. Thank you, Bill.
Thanks for having me.
Appreciate it. William Lee joining us from the Milken Institute, the chief economist.